Investing in the wrong suburb is the biggest mistake you can make, and it can cost you hundreds of thousands of dollars. In this video, I'll give you a proven framework I use with my clients to find growth suburbs before anyone else does, so you can lock in the big capital gains and secure your financial dreams. And just to be crystal clear here, we're talking about investing to make money, not buying a place to live in, which is a totally different decision. Now, the suburb you choose is the biggest driver of your growth. You can have the right loan, the right tenant, the right strategy, but if the suburb is wrong and doesn't grow, your returns are capped before you even begin. A lot of investors stick to their own backyard or what their mates tell you, and this is a completely wrong way of going about it. But the professional investors follow a proven framework and use hard data to make investment calls. So now that you understand why suburb selection matters, let's get practical. And we do that by starting with the first step, your budget. Australia has over 15,000 suburbs, so how do you even know where to even begin? The easiest way is to start with your budget. Once you have a set price range, you can instantly filter out thousands of suburbs you can't afford and focus on only the ones you can. Let's say, for example, your budget for the investment is between $450,000 to, let's say, $650,000. Straight away, you have disqualified thousands of suburbs from consideration. Now, you can always adjust your budget upwards if you want more suburb results, but this is a good starting point. Now, once you've got that budget, this is where the research tools come in. I'm talking about using DSR, HTAG, SQM research, and even the advanced filters on realestate.com. These tools let you plug in your number and find out the best suburbs within your budget. The reason we use this is because these tools allow you to spot areas where demand is strong and supply is tight, which is the core driver of property growth in the immediate years. I break down exactly how to measure that in the next step. By starting with your budget and applying it to these tools, you can take these 16,000 suburbs and narrow them to a handful that can actually be within your reach. From then, the next step is to drill down into these qualified suburbs and start scrutinizing the actual numbers. And that's where step 2 comes in, where you can analyze the demand and supply metrics. Now that you got your shortlist from step 1, let's talk about the most important law of price appreciation, the supply and demand metrics. When there's more buyers in the suburbs that are competing for fewer property, prices go up. And vice versa, when there's more stock than demand, prices either stall or sometimes even fall in the market. In this step, we're looking for signs of capital growth, and that means looking for signs of strong demand and tight supply in the suburb, because this means that the market's primed for prices to go up. So let's go through the demand metrics. The first one is days on market. Now, if you don't know what days on market means, it's pretty much how many days it takes for a house to be sold in the market. Now, if the days on market is less than 30 or less than 40, that means it's a very high demand in that area. And vice versa. If it's taking 50 days or 60 days for the house to sell, that means it's a very cool market. It's not many buyers looking into buying. Now, the second metric I look at is sales volume. So what sales volume means is how many houses are being sold in that specific month. If there's more properties being sold than in the previous months or years, that means there's more active buyers. The third metric that I like to look at is vacancy rates. So what vacancy rates is per area, how many houses that are for rent, how many of them are vacant, right? And if you have a market where the vacancy rate is less than 2% or even close down to 1%, that means that a lot of the rentals in that suburb are being snapped up, which means that there's a huge demand for that area. Now, what happens is that because these tenants are chasing in these areas, the flow-on effect is more people try to move into those areas, which means that more people are looking to buy in those areas eventually and push up the demand. Now, let's look on the other side, the supply metrics. This is how you check if the supply in the area is quite limited. The first one is stock for sale. And this means how many listings are for sale. And if there's fewer listings than there were in the previous months, that means that the supply is tightening. The second key metric you look at is building approvals. If there's little construction or approvals for new buildings in the suburb, that means supply cannot ramp up quickly. And that means that the supply is very limited in the area. This preserves price growth. Third metric, checking the developable land. If the surrounding areas can be converted into land to be built, this will increase the supply and stunt the capital growth. So you want to invest in areas that are already been pre-built rather than areas that have huge amount of developable land that can be converted. Now, if a suburb meets at least 3 or 4 of these benchmarks, it's really good. If the houses are same are under 30 or 40 days on market, the sales volumes are steady or rising year on year, the stock levels are low or trending down for at least 6 months, the rental vacancy rates are under 2%. If a suburb ticks most of these boxes, market pressure is already pushing the price up, and it's worth taking to the next step. In step 3, we dig into the why behind these numbers so you can work out if this growth is sustainable or if it's just a short-term blip. Step 3, identify the growth drivers and spot the red flags. Numbers tell you what's happening now. Growth drivers tell you why it's been happening and why it's likely to keep on going. This step is finding the forces that create the demand and limit the supply in the suburbs that made it through step 2, and making sure that these forces aren't about to disappear. Now, here are the positive growth drivers. The first one is infrastructure investment. So I'm talking about like new train lines, upgraded highways, hospitals, schools, and shopping centers to make the areas more connected and livable. The second one I like to look at is the employment hubs. Is there a mixture of industries that keep the economy stable in that suburb so that if one sector slows down, the others keep things moving along? And the third one is lifestyle appeal. Natural beaches, parks, cultural areas that people can live and enjoy. If a suburb has 2 or 3 of these drivers, it's worth keeping on your shortlist. On the other hand, here are the red flags you want to avoid. These are like the deal breakers. The first one is single industry dependence, like on mining towns or tourist hubs, because one downturn can wipe out the whole demand in that suburb. The second one you want to avoid is oversupply risk. So these are huge amounts of vacant land, large, high density project, or massive rezoning that could really flood the market with new housing and stunt capital growth. So what do you do if you spot these risks? Well, if a suburb relies on one volatile industry, cross it off your list, no matter how good the numbers look. If you see a huge housing project or rezoning, this could be a red flag due to the influx of supply. And if the approvals are really outpacing capital growth, supply will overtake demand. And that's another red flag. When in doubt, you can always check websites like H-Tag, or you can call the local council planning department where they can tell you exactly what's approved or what's proposed and how it might affect the market. Once you confirm the growth drivers, rule out all the risk, you've got a shortlist that's affordable, in demand, and set up for long-term growth. Now let's move to step 4, getting ready to act. Finding the right suburb is a crucial step, and now you know exactly where to start. Most investors never get this far, but remember, with each suburb, there are good and bad pockets. Some areas might be near industrial sites, be next to a housing commission, or sit across from a graveyard or large-scale future development. Overall, if the suburb is performing well, these factors can drive down these areas and slow down capital growth in that specific pocket. So pocket selection and property selections are a whole other topic for another video. For now, your job is to get yourself financially ready to act. So you need to line up your pre-approval, stay in contact with your local agents, and keep an eye on the shortlisted suburbs for major changes that could affect their capital growth. And if you're ready to get your finances sorted and want one-on-one guidance, I'd love to help you out. Book a free call with me using the link in the description below, and we'll work out through your plan together. Now you got a solid plan for picking a suburb in a potential growth area. But here's the thing, it won't mean much if you can't get your finance. If you want to know how professional investors build a portfolio of 20, 30, or even more properties while still being on a modest income, please check out this next video. I'll walk through the exact strategy they use to keep buying without hitting the borrowing capacity wall. See you there.